Assalamualaikum warahmatullah. Welcome back to our discussion on time value of money in Islamic banking and finance. We see earlier that we see that the notion of TVM is that it is a neutral conception. There is no inherent evil or immoral about it. It is only when it is used to justify interest or usury that we will question the use of TVM in Islamic finance, because the justification of profit created from murabahah or tawruk require more rigor than just the notion of time value of money. To what extent is TVM qualified to become the reason for the charging of profit of Islamic debt financing? So we need to further look into this matter so that our scholar will be able to present a convincing theory or idea how to justify the charges of profit arising from debt financing. We don't have any issue about charging of profit based on spot payment because that has been clearly discussed and defined in Islam. That is lawful profit is explained by property, al-mal, kasab, effort, and daman, which is responsibility. But when we move on to look at the payment by installment or involving deferred payment, then that component of profit due to the postponement of payment requires some theoretical explanation, which until today we are still not able to get a good and precise reason behind the charging of behind the permissibility of charging profit based on deferment. Now, if we look at this diagram, this is the normal illustration regarding the time value of money, where future value is the sum of present value and the interest rate. Okay, so for example, if you have a loan which is the present value of 100,000 and the finance charge is the interest rate at 5% per annum with a tenure of 10 years, then the interest income can be found at 50,000 from the $1,000 multiplied by 5% multiplied by 10 years, we got $50,000. And therefore, the total debt created from this loan is, which is the future value, is $100,000 plus 50,000 plus is equal to 150,000. So that is the total debt created from the loan, and that will be the debt obligation of the borrowing customer that he or she must settle over the contracted time period. Now, when it comes to murabaha, then we are referring to the sale price, which is the future value, comprising of the facility amount of 100,000 plus the profit margin based on the profit rate of 5% and the tenure of 10 years. So the profit margin is calculated at 50K, and we got the sale price of 150,000, and therefore the future value for a loan and for a murabaha are equivalent. And this is when we need to look into to what extent the sale price that contain the profit margin of 50,000 based on the finance charge of loan rate of 5% per annum, and that would be the TVM imputed into the interest margin or profit margin, and therefore we need to, as I say, we need to further look in with more rigor the justification for the profit margin in the Islamic finance. Of course, as I said earlier, the sale price is quoted to refer to the fact that any Islamic contract must be able to disclose the selling price, and the selling price has been disclosed, but then the profit margin, which is a component of the selling price, need to be further caressed and justified to ensure that we understand well how this profit margin is allowed to be consumed, given that this profit is derived from postponement, from waiting, which is quite similar to the interest rate that we see in the loan financing. So a lot more thinking need to be done in this matter. So we will try to see if we can move on and to provide and for us to provide clarity and rigor to Islamic finance to further clarify and provide some justification for the award of profit based on deferment. And I would presume that the Shariah board or Shariah advisory committee, the people who are Shariah scholar, must also be involved in the justification for such profit margin, so that any fatwa or resolution provided, is can be much consumed by the general public. Thank you very much. We can discuss this matter again in the future. Assalamualaikum warahmatullah.